objectives.
Okay, so team will be looking at financial analysis. I'll call it part 1. Then hopefully in the evenings, if we still have a bit of some time and the internet, if it's going to be on our side, the internet network, if it's going to be on our side, then we can have part 2. So that tomorrow we can organize some time to start looking at cash flows. Just only these 3 things, then we'll focus on them. You can do a bit of some standards. I think I'll just check some few lessons that I've done on standards for you just to acquaint yourself. So today we'll look at financial analysis, and as the picture depicts some, where one is drowning, a company might be drowning, and maybe because they haven't done some financial analysis, they do not know that the company is drowning. Not until you do the financial analysis, you'll be able to see where the company is, where it is going, whether it is actually a going concern. You can now develop some medications or antidotes of some kind which will help your company from going under. It's not as easy as people think that, oh, this company has gone under, but look at the lives behind that. Lives gets actually distracted. Lives become very unbearable. People lose jobs. They also lose assets. So it's a very important aspect in your profession as professional accountants to be, or professional financial advisors to be, to make sure that you do some unbiased analysis on your companies and advise their next course. So this is why we'll be learning financial analysis today. So we'll start with financial performance. Obviously, the first ratios under financial performance will focus on the income statement, because that is where the balance sheet, basically the balance sheet, it is there to generate. The balance sheet is more of an infrastructure that helps you to generate necessary incomes. That is what the balance sheet is there. So when you look at the first part of the balance sheet, like I've always said, that the first part of the balance sheet is basically the eyes. It's things you can see, it's things you can touch. Whereas the last half of the balance sheet, which is equity and liabilities, it is basically the ears. It's things you hear. So the things you see and things that you are able to touch, how are they being funded? So they're being funded by the things you hear. Maybe what you have heard is that the asset base is actually being funded by your own money, which is basically your equity, or liabilities, which is actually through other people's monies. But then why are you having those assets? You are having those assets for you to expand your income base. And this is why we are looking at financial performance today. You cannot look at financial performance from the balance sheet view. No, you will look at financial performance from the income statement view. From the balance sheet view, all you'll be doing is that to check, are these assets, lazy assets, are these assets able to generate the meaningful or the targeted income that I need? And if not, why? So under financial performance, we'll start with the gross profit margin. It looks very basic, but it is one of the most important metrics in organizations that you should actually focus on. For example, an increase in gross profit margin, what does it show? An increase in gross profit margin, it might actually show that you have come up with efficient ways of using your materials. Maybe you have new technologies that are helping you to efficiently convert your raw materials into sellable products. It could be that there's just been a general reduction in the pricing of your inputs. Therefore, that general reduction, you haven't reciprocated it on the sales line. Your sales remain as is, the selling price remain as is, yet the cost of production is going under. It might also mean that you're doing very unethical things. There are some unethical tendencies to those nice numbers that you have. Possibly you have started actually employing underage whom you are just giving peanuts, not good money. So that might actually cause your gross profit to go up, but there's some unethical tendencies that are coming in that you are using. So you need to actually look at this. And this is why when we are doing analysis, we look at the trend, because the trend then gives you an understanding of what truly is happening. Does it mean that now you have employed more efficient ways of producing? And this is why you're actually having a higher gross profit. Secondly, it could also mean that in that year where you're having a gross profit margin, a high gross profit margin, it could mean that there was some mispost, for example, or there's a certain activity that you did not post to the cost of sales, which maybe you capitalized by mistake. There was truly a mispost. So it has given you a very good result. So you have to go into the numbers, do some good account analysis or cost analysis. If, for example, you have been having a very stable gross profit margin, say, for example, your gross profit margin is about 70%, then in that particular year under review, your gross profit margin has dropped. For example, it has actually gone to 55%. The question is why? It could be just that there was some mispost. Some costs, or should I say some capex could have been plugged into the cost of sales. Wrong accounting treatment. So it took the cost of sales up and reduced the gross profit margin. So you should be looking at all these small things when you are doing an analysis. Yes, you are actually doing this for exam purposes, but open your mind and look at these things in a more logical way. And this is why we're saying changes in the gross profit margin over time should be analyzed further to identify the cause. Has the company introduced new products, for example? Is it cutting prices to increase market share? Was it unable to pass on inflationary price increases? What is happening? Or maybe there's some statutory effects to it. Maybe it's something that the government has come up with, which you are forced to oblige, and therefore it has actually crushed your margins. Or it could be the FX, the foreign exchange. Your currency against the major convertibles is deteriorating and therefore affecting your margins. So the question is, what is really happening? And the students have a problem with financial analysis. They think it's easy and they go into it as a person who used to mark and examine Zika exams. Then obviously I stopped. I used to see it clearly that students would rush for a financial analysis question, yet they don't even know how to respond to it. I know maybe today in the evenings, if we have time, I'll show you the right terms you can use when you're actually doing your financial analysis. You will not say management should, must. You leave the term should and must. Those terms are reserved for God. It's only God who should use must and should. So you need to know the terminologies that you use when you're actually looking at financial analysis. So that is on gross profit margin. It's very important. Gross profit margin, why in the financial world we elogize it for some reason, is because it looks at the cost of sales. Your principal costs, these are costs that you cannot avoid. These are costs that are connected to your sales. So we cannot ignore them. These costs could be maintenance of your infrastructure, your actual sales of the product that you have. What's the cost of selling this particular product? So when you are responding to financial analysis questions, just open your mind, be logical, ignore the textbooks, just be logical. And when you check, let me go back. When you check on the gross profit margin on any ratio, the solution lies in the formula. So if you are advising management, you are actually saying, therefore management is advised to look at these issues. And also in the exam, you're not given enough data. So you have to put in a disclaimer to say, however, the data available is not enough for blah, 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 blah coming up. But based on the data, these are the things, and there could be other things. So you are coming up with speculative reasons why gross profit margin reduced. So in this case, you want to improve gross profit margin. How do you improve it? It's either you increase the denominator, like in the gross profit margin. First, you look at it, what actually makes up gross profit? So what makes up gross profit is the cost of sales and sales. So it's either you increase sales and reduce cost of sales, or do both. So how do you increase sales? So sales could actually increase by coming up with all these promotions and all these other things. It may actually affect, sales may increase, but you need to make sure that you are coming up with prescriptions that do not increase sales by 2%, yet increasing revenue, yet increasing sales by 2%, yet increasing the cost of sales by 2.5%. Then you're actually not going to get it right. So we are done with gross profit margin. Today is just the explanations. Then we look at the operating profit margin. Under the operating profit margin, here now you're actually bringing in other operating expenses, not the primary expenses, because the primary expenses are cost of sales. So you're bringing in admin costs, you're bringing in distribution costs, yes, Ernest? Yeah, okay, we are recording, and we are recording the class, the lecture. But try to get in. Okay. Okay. Sorry. There's a problem with the internet, but let's move on since we are recording this. So here now you're actually looking at a whole operating profit margin. Like I've told you, all you have done, it's like you have come up with an addendum to your gross profit margin. In here now you have brought in your admin, you have brought in your distribution costs, and these other what we call period costs. These costs that will be incurred after you've just produced or whatever or sold. So here now you're actually looking at the selling, general, and administrative expenses. You're looking at depreciation. So an analysis of the causes of change in this percentage might reveal that the company's other costs are increasing or decreasing at a greater rate than sales. So it might give you an understanding of saying, what are the admin costs as a percentage of revenue? Is it increasing? Is it reducing? Should we now scale down on period costs, on selling, on selling general and administrative, which is basically the SGA? What should we do? Should we digitalize most of the processes so that we are able to reduce on the costs? If we digitalize, what are the costs of digitalization? Are these costs being driven by behavior like most of the costs are driven? How can we curb behavior? How can we manage behavior so that we manage our costs? So basically that is on operating profit margin. I know it has been a long day, Sid, and you're tired, but let's finalize on the analysis.
No, I am getting this agenda well. On operating profit margin, an extension to increase on the other administrative expenses. Yeah, getting there.
So then you go to Rossi. Here on Rossi, and that's quite interesting when you are looking at return on capital employed. Obviously, you can look at year over year analysis to see whether you're doing fine. But actively, if you want to, you can still compare your ROCE against the cost of money, for example, against the returns that you'd make if you had to take this money into treasury bills. How much would you make? So you can still start comparing and doing your analysis from that level. So here, return on capital employed, we are saying it is profit before interest over the capital employed. The capital employed, we're actually looking at debt, which is interest-bearing debt in this case, and equity. That is what you are looking at. Or you can say assets less current liabilities. It will give you the same number that you have under net debt plus equity. So here on the return on capital employed, and you are very specific. You are looking at your equity. You are looking at debt, net debt, which is interest-bearing debt. You are not looking at any other thing. So from your interest-bearing debt, because you know whatever procurement of debt you are doing is to increase your assets up there. So that once you increase your assets, you are hoping that you're going to increase the productive capacity of your revenue generation. And this is why you're doing that. So it's basically measures the levels of returns a business has made using the capital it has within it. And like I said, then you can compare ROCE against your treasury bills, against government bonds, to say, had we been patient and invested this money in the financial markets, what would be the return against what we're getting? Then you see whether what you're doing, it doesn't make sense or it does make sense.
Sure.
So it allows for comparison of overall performance year on year, like we said, as well as allowing comparison to an entity in a similar industry of different size. Furthermore, you can actually do that comparison with the financial markets, the returns from the financial markets. You can do that because this is your money which you have decided that, no, this money that I've borrowed and this money that I have, which I've used into this particular project or into this investment, this is what I'm getting. But had I combined these two sources of financing and taken to treasury bills, how much would I have? Some few weeks ago, I was training about, I think, 1,200 KCM employees. And I was just telling them that, you see, if you have two people, one person decides to get a 300,000 kwacha to get that 300,000 kwacha as a loan, invest it in buying, in building a house. The other person gets that 300,000 kwacha, decides to wait a bit to say, no, I'm going to take it into treasury bills for about 3 years. The person who has built a house who may actually, if the salary is not that good, may start struggling to actually pay the debt. The other person, because, for example, if the interest rates, like the ruling interest rates, are about 28%, and the treasury bills about 18%, meaning that from his salary he'll be able to pay 10%, because he gets 18%, he pays 28%, meaning that from his salary is paying only for 10%, whereas the other person is paying 28% cost of money. And maybe the salary is not okay, he starts struggling, he might end up selling whatever he had actually started building. And he's not going to finalize that particular building. By the end of 3 years, that building maybe to just go by window level, and you struggle, but you'll continue paying the principal and interest on what he borrowed. The other person has reduced the gap. So instead of paying 28%, it's paying 10%, because it's getting 18% from the treasury bills and paying 28% for that particular money, that he just got that money and invested in treasury bills and starts paying 10% of it. I don't know if you're getting what I'm trying to say here.
No, I get you. And sometimes people think building a house is the best way to invest. I have come to discover that the return on investment is very bad, it's very poor. Because it will take you maybe even 20 years to start recovering.
Yeah, and it's just basically a store of value that when you are broke, maybe not being broke, let me not use that term. Maybe you have other investments that you want to do. You can still sell that thing, or can use it as a collateral and use that money for other things. But like I was saying, in the 3 years of a person who has gotten 300, the other person gotten 300 because he will still not manage to finalize the house. That person, you have serious in terms of the financial cash flows. The other person, the cash flows will be okay because he's just paying 10% of his salary, whereas the other guy is paying 28% of his salary in terms of the cost of money. The cost of money, 28%, sorry. After 3 years, this person who had invested in treasury bills or whatever, or government bonds, is given his money with the coupons. Now he can use it to build free from debt, or he can now put it back and start using the coupons to build their house. So it's just different mindset. So here it's just on the return on capital employed. Like we have said, it's just the profit before interest and tax divided by the capital employed. By capital employed, our definition of capital employed is the interest-bearing debt and equity. Now you also need to look at the net asset turnover. Here the question is, from the capital that we have invested in this business, first, from this part, from the capital that we have invested in this business, how much returns are we making? From every quarter that we have invested, are we making 10 ingwe of that 10 kwacha? Is that 10 ingwe better than what we generated last time? Is that 10 ingwe better than our target? Is that 10 ingwe better than the industry norm? Is that 10 ingwe better than if we had invested in the treasury bills? So this is how CDN you should analyze it for you to get easy marks. So now on asset turnover, here obviously you're looking at how many times are you going to generate from your capital that you have invested, your capital employed. What are your revenue? Every one quarter that you invest, how much revenues are you making? If over time it has reduced, what has reduced that? It could be that the property, plant, and equipment that you have bought are technologically advanced to an extent that the current crop of employees you have cannot fully use or utilize the machinery. You remember that thing that was bought, I think, by Rasa from Germany. the machine that we are using for fitness and whatever, where a car passes through most of these .com cars we buy from Japan, then the machine says it cannot read, it cannot see that there's a car that has passed. So the technology was up there. And maybe the issue is that people didn't know how to use those equipment. So what does it do? Then it reduces your revenues or something like that. But these are numbers that you can easily manipulate. Return on capital employed, a number of people have manipulated these things by almost going closer to the end of the year by disposing of most of their assets. So when they dispose most of the assets, the capital employed reduces. So they are trying to reduce the denominator so that they increase
the revenue.
Yeah, so that they increase the ratio. So if you reduce the capital employed down there, yet you have the profit, your operating profit on top, which is higher, then you're actually going to increase the number. So you can manipulate that. And even when they sell them, they list them back. So meaning that they still have these assets. Not until the new IFRS 16 on leases that are coming that you have to show there's nothing like calling it a finance lease or an operating lease. Everything should go into the balance sheet so that it shows the maximum exposure. But these are ratios that out there, financial gurus are able to manipulate. So on non-current asset,
I was looking at those grinding mills that are dotted all over the country. Yeah, when you look at the net asset turnover, you really see that it's a waste of resources.
Yeah, because obviously then you look at if you are looking at ROCE, you are going to realize that the returns are almost to zero. Maybe there isn't significant revenues coming from there, going by how much net debt you have brought in and possibly your equity, if you at all those equity. Obviously, maybe 15% of that is equity, what we call counterpart funding, and 85% is coming in as debt. Then you check, you find that the returns are actually almost to zero or whatever. So you're able to see all these things. Even when now you come to non-current asset turnover, which is also very important, here now you focus just looking at your property, plant and equipment. So you look at revenue. So you're actually asking yourself, for every investment in our non-current assets, how much revenues are we generating? Because it's your property, plant and equipment that helps you to generate your revenues. It is your hammer mill or your chigayo. It is all these assets, the non-current assets that you are building into your company, or a build-up of these assets should ultimately help you to increase revenues. But if it doesn't increase revenues, yet you're actually bringing in, you're spending on CapEx, what it means then is that you are spending on what we call lazy assets. These are assets that are not in a position to generate meaningful revenues for you. So the question is, what motivated you in procuring those assets? Did you get it wrong in terms of your assumptions, where you thought if you bring in all these particular assets, non-current assets, your revenue base is going to go up? Maybe your revenue base is not going up because it is restricted by market, by your market share. Your market share is constant. So you're not bringing in new customers. And the question is, why are you not bringing in new customers? Are your competitors much better than you? So this is why now you start thinking of heavily advertising in marketing and promotion or what, so that you can draw into the market share of your competitors, because you have these new assets, you have invested more in CapEx. Your aim is to increase on revenues, but if your revenues remain, it's either your asset base, your non-current assets are what we call as assets. They are not able to generate meaningful revenues. Your projections were actually bad. You did not actually factor in the strength of your competitors, that they have locked in their customers. Whatever freebies you bring in, those will not actually make them to come to your organization, start buying your products or whatever. So non-current assets turnover, we are saying this is the overall measure of the efficiency of a company in generating sales from its investment in non-current assets. Like I said, your balance sheet must be a very productive balance sheet. Don't invest in things that will not be able to generate or to increase the revenue base of your company. So your balance sheet is there more as a machine, so to say, as a machine that helps you to generate revenues. So if you are increasing your balance sheet, yet your revenues remain the same, your cost structure remains the same, then there's a very big problem in the way you are doing your projections. And that is actually detrimental to the health of your company. So your company eventually is going to be so obese. It's going to be obese because your balance sheet, it will contain a potberry which is not meaningful. You see what I mean? Instead of having the six-pack and all that, your balance sheet has a potberry. Then you start having now all these issues because your balance sheet has a potberry. Starts having all these funny conditions, that conditions and all that. That's what it means. So a balance is just like a human being. Just like a human being. Yeah, it's what I mean. Yeah. So we are saying the minimum investment in assets to generate the maximum revenue is an indication of efficiency. So how healthy is your balance sheet? You have to make sure that your balance sheet, you make it a bit lean. Your balance sheet becomes so fit that it is able to generate meaningful revenues. Avoid having a balance sheet that has a potberry. Meaning that you are investing more. And for me, if I'm doing an analysis and looking at the balance sheet, the first thing that I do, I first look at your injection or your investment in your property, plant and equipment, your non-current assets. When I see it's going up, yet your revenue remains the same, then my question is, why were you investing in your property, plant and equipment, yet your revenues has remained the same? What has motivated you to doing that? So it means that you are growing a balance sheet potberry. So how do you reduce that? How do you reduce that balance sheet potberry? Obviously, is by selling some of the assets that you have bought, because you have proven it that these assets, they are not increasing your revenue. So we expect if your balance is going like this, your revenue is going at a higher rate than the growth of your non-current assets. So if that cannot be done, cannot be seen, then start divesting. That is where now they reach at a level where the recommendations of companies, where they start now doing what they call asset retrenchments. As much as you retrench human beings, you can also retrench assets so that you have a very healthy balance sheet. Is that making sense?
A lot of it, actually. Even selling it.
Yeah, that's what we are saying when we're saying asset retrenchment. Asset retrenchment, you are retrenching them, but maybe at a price, obviously.
Yeah.
You're not just giving them out for free, you're retrenching them. All you're doing, you're removing that potberry. That is what you're doing. Because you know that it is not productive, it's actually a very useless feature to have even on human bodies. You get it, Sidin?
I get it.
It's not a good thing. So try to remove that potberry.
No, I will try. We'll remove it. Go.
Yeah. So I say the minimum investment in assets to generate the maximum revenue is an indication of efficiency. So it shows how efficient your assets are, your non-current assets are, as far as generating meaningful revenues. So however, it may in fact deteriorate in the short term if a company is replacing heavily depreciated assets with new equipment. You should actually see that obviously there should be the time that you're introducing these new equipment, you might not use them to the fullest of their potential, of its potential, so to say. So you can see a drop in terms of this particular ratio. But going forward, you should expect it going up. But if you have invested and this thing still continues going down, then you should be worrying that you have actually made your balance sheet more obese and there's need to work on it, and maybe to bring in Dr. Phil. Remember Dr. Phil from CNN, who just cut and remove the fats and sew you up, and then you're better off. So some factors to consider when you're looking at this analysis is the timing of sales. So you have to look at the timing of sales. Maybe when you brought in these assets, you brought them maybe in October or so. Yes, they've increased your non-current assets down there as a denominator, but they did not come in from the word go in January so that they can fully help in generating your revenues. So they came in last year, is what I mean. Just at the far end, almost at the end of the financial year. So they've increased, yes, your non-current assets as a denominator and affected your ratio. So you need to look at these things. What's the timing of sales? Asset efficiency versus profitability, you have to look at all that. What is the asset valuation policies? Maybe what they have done is that they have just valued the assets upwards, and that has caused this problem. And for me, this is why I like IS36 on impairments, because IS36 comes in to, you are doing evaluation. Yes, you are going to do your DCF, but then it actually shows what's the recoverable amount against the carrying amount. So if there's an excess, if the carrying amount is higher than the recoverable amount, then it means that that difference has to be impaired. Or what this standard is saying, that can you actually slim your balance sheet so that your balance sheet can be healthy again, to generate meaningful revenues. Now we go to the financial position, where now you look at the liquidity ratios. This is where you do your working capital engineering. And we do this in the corporate world, where you develop a model and you start working on the liquidity engineering, working capital engineering. They say cash is king. It's possible having a company that is highly profitable, yes, yet has problems with liquidity because of your policies. Maybe you've come up with the policies that are so relaxed on receivables, very relaxed, and you're creating more profitability because the revenue base is going up because of how you've relaxed your receivables policies, yet you are broke. So here we are looking at the ability of a company to pay its obligation as and when they fall due. And this is a major concern of any credit analysis. So short-term credit liquidity can be assessed by comparing current assets with current liabilities in a variety of forms. So the basic working capital equation is the current assets less current liability. That's the basic one. So if you find a situation where your current liabilities are higher than current assets, then there's a very big problem, meaning that as and when you need to actually meet those obligations, you may have a very huge challenge. Anvela Sido.
Sure. Good.
So here, when we are looking at working capital, there'll be issues of actually looking at the inventory. At what levels are you keeping your inventory? Because obviously we know that inventory is a cost. It is a cost in the sense that you're actually tying up capital in your stock. So we will have to look at all those things. You have to look at receivables. How long do you take to generate cash inflows from your receivables? Then payables, how long do you take to pay them? So we'll have to look at all these other areas. So under liquidity, first you start with your current ratio. Here, what you are doing is It's the same thing of saying current assets less current liabilities. It's the same thing, but here now you're saying current assets less current liabilities. It's a ratio. So you expect that you should have a ratio that is more than 1, meaning that your current assets must be higher than the current liabilities. If you find that it's lower than 1, then what you're saying that the obligations out there that have to be paid within a year are much higher than your potential cash inflows through your current assets. So under current assets, obviously you have issues of inventory, you have this, the same cash itself, you have receivables, and it's much lower than the current liabilities. Then it's just threatening in a way, even threatening your going concern. In a way it should. Because cash is king and your liquidity ratios are in negative, then it gives you a very big problem. So a current ratio of over 1, where I've already explained. However, some companies function adequately on current ratios of less than 1, whereas others need a much higher ratio. So depending, like for malls, you go to ShopRite or whatever, I'm sure their current ratio must be, even if it's lower than 1, it could be fine. But all we are actually saying that as and when you are supposed to meet that obligation, you should actually be able to meet it. So the analysis must be very clear. So yeah, trends are difficult to analyze, but generally higher ratios indicate greater liquidity, but also pay attention to the nuances of these ratios. You may find in a particular year, in the current year under review, in the year under review, you might find a situation where your current ratio is above 1. Whereas in the previous period, your current ratio was less than 1. Do not conclude easily, like just a person from the street. Do not just conclude easily that in the current period, your liquidity is far much better than the previous period. Maybe what it is that in the previous period, cash as a percentage of current assets maybe was about 70%. Then you had the receivables of about maybe 15% and inventory of about 15% of the current assets. But in the current period, you have 15% of cash as a percentage of the total current assets. Yet you have 70%, or should I say 70% of receivables and 15% of inventory. So I would clearly say in the previous period, in terms of the cash, easily cash, you were much better in terms of liquidity than you are today. Because today now you have this particular ratio that is very huge in terms of the receivables. And from your history, maybe these receivables, they qualify to be candidates, to be doubtful debts candidates. So you have to look at the nuances. You have to look at the numbers. Do not just look at what the textbook tells you. No, liquidity is lower than 1, and then there's a problem. No, look at also the composition of that particular liquidity or that particular ratio, the current assets. So look at that. And here to consider, obviously, you're looking at the asset quality, like I was saying, you're looking at that composition of the way your current asset is. What's the asset quality in it? And that is what I'm explaining. You're also looking at seasonalities. So from current ratio, then now you can move on to the acid test ratio. To the acid test ratio under this, yes, it is still a current ratio which has been upgraded, where now you're removing what you think these are items that are not easily convertible into cash, such as inventory. So then now you look at the quick ratio, which is basically the acid test ratio. Under this, you have convinced yourself that inventory is not easily convertible into liquidity. So you try to remove it. So you believe that receivables are easily convertible into liquidity than inventory. If it's vice versa, there's no harm to have current assets, less receivables. If from your analysis as a company, you have discovered that inventory is easy to be converted into cash than receivable, then you can change the formula. But in this case, I know from on average, it's the inventory that is difficult to convert into cash. And this is what we're saying, let's try and remove it so that we have an acid test. Let's test the acidity levels of this particular ratio and see whether we should be in a better position to pay back our obligation as therefore due. And these obligations, we are looking at short-term obligations. Sido, are we together?
Yes, actually I get it. Now, this is the acid test ratio, meaning that you have to remove inventory. Then you go ahead and don't remove. You said you can elect not to remove inventory because
yes,
in your mind inventory.
You remove receivables, but obviously in your exam purposes, don't do it like that. But what I'm saying is that in the corporate world, when you do this analysis, you may find a situation where you believe that it's very difficult to extract cash from your receivables after you've analyzed and you have this trend. So you can make receivables, you can remove receivables from your current assets because you believe that receivables are also becoming a problem. You cannot easily convert them into liquidity. But in this case, for your exam purposes, just remove inventory. These are analysis that we do in companies, just to analyze and check, oh, I think this will have to remove it. Even just from there, you can isolate the type of receivables that you have. There could be certain customers that you believe that they are a problem in terms of paying, but maybe the question is, why are you still giving them that facility? Maybe that, yeah, but we are in Africa, so there could be certain aspects why you are getting forced to give them. So you can still remove that so that you see the acid test. The acid test doesn't mean that always you have to remove inventory. No, all you're doing, the principle here is that you're removing an item from your current assets, which you believe that cannot be easily converted into cash.
Yeah.
Hello?
Sure.
You're getting it.
I'm getting it.
This is basically storytelling on the financial ratios. It's just storytelling.
But very helpful.
Yeah. So you're saying a comparison of the quick ratio and current ratios, it shows increases in both. The current ratio increasing more would indicate that the company has been building up stock. So you're able to see all these things, like I've said. So then you can go on to looking at inventory days. Obviously, it's inventory days over cost of sales times 365. This shows how long a business is holding its inventory. How long are you holding on to the inventory? At most, it should be less than 30 or 60 days. If you find that it's going to over 100 days, then you start questioning your inventory policy. Why are you holding something that you cannot easily convert into cash? Why are you holding on to inventory, which is coming at a cost? And what's more, you might actually suffer a cost of obsolescence because you're holding for more than too long. Technology might actually overtake a number of things, and your inventory may be significant in that particular scenario. But then also you might be holding on to inventory if it's more than 60 days. It could be for strategic purposes. Maybe you know that in the next few years, in the next few months, you will have problems in terms of this particular material. So you have become strategic as a company to access stockpile, but it should be for strategic purposes, not for lack of strategy. I hope you're getting me. So when you see inventory days going up in a particular period, do not just conclude that there is a problem here because the inventory days have gone up. The question is, go into the details. Why did they stockpile? Are they anticipating that there will be lack of these materials in the next few months, few years? Is it for strategic purposes or is just for lack of it? So even in the exam, you can say, based on inadequate data, then you state what you want to state and bring in assumptions. And this is how beautiful it is looking at a financial analysis question, because it gives you a leeway to create assumptions, but they have to be educated assumptions.
You start imagining.
Then also, for your inventory going up, it could also mean that you are actually holding on obsolete materials or unsellable inventory. So can't you find a way of retrenching that inventory, which is lazy, which is not required at that moment? Maybe there'll be need just to retrench it through auction sale, or companies conduct these auction sales. That's the best way to actually retrench inventory.
True.
I hope the storytelling on financial analysis is very practical. It's actually hitting home.
Yes, it's arriving.
Okay, that's good. That's good. Trade receivables. Here now you are looking at the trade receivables days. Providing revenues evenly spread throughout the year, the ratio indicates how effectively debts are being collected. So here it actually shows if it's for 30 days, then you're actually saying if you give your customer, if you sell to your customer on credit, within 30 days, you actually expect to receive cash. But if it goes beyond, what could be the problem? The problem could be maybe there's an economic problem. As a country, you're facing an economic problem, so a lot of people have become very illiquid, and it's now becoming difficult for them to actually service their debts. That could be also another issue. So an increase in the ratio of receivables revenue could provide the proportion of cash sales has not increased, indicate one of the following. Receivables have been given or are taking longer to pay. What are the terms of trade? Why are they taking longer to pay? So there could be a lot of issues why they're taking longer to pay. Why are you taking longer, you as a person? And always come up, bring yourself into this particular scenario as a person. Why are you failing to pay someone whom you got, say, 5 chickens at, say, 500 kwacha? You promise you are going to pay and you're failed to pay. Why? It could be because you are no longer in employment and it's becoming difficult for you to pay.
Yeah.
It could be that there's a slump in the economy, and the salary that you're actually getting has become almost useless. So it's becoming very difficult for you to actually meet these debt servicing obligations. So you have to look at that. Why are they failing to pay? So you do an analysis and you bring in assumptions. So the total receivables figure includes long outstanding debts. Should provisions be made? This is why now you bring in your IFRS 9 on provisioning for doubtful debts.
Yes.
You go on to the trade payables days. So here we say if purchases are spread evenly throughout the year, this ratio will show the length of credit the company is taking. So here an increase in the ratio may indicate that more reliance is being placed upon the payables to finance the business. But the question is, if you see that there's longer trade payables days, is it based on strategy that you have decided not to pay the suppliers with a view of actually using those finances to fund your operations? And if it's by strategy, have you had a word with your suppliers that this is what you're going to do? Or the longer trade payables days review a picture of the challenges that the company is going through? So the question is it based on strategy, or is it based on your going concern or your liquidity challenges as a company? So those are the things to look at here. And those are the things when you're in the exam, those are the things to start writing, and you write intelligently or very educated.
Yeah.
So solvency or gearing risk. Here now, you're looking at the gearing ratio. How geared are you? How leveraged are you as a company? Here, it's basically your debt against your equity. Others would say net debt over equity plus interest-bearing debt, depending on how you're looking at the gearing ratio. But an increase in the gearing ratio indicates that either borrowings are increasing faster than equity, or equity is falling more quickly than borrowings. In extreme cases, borrowings may be increasing while equity falls. So in the first case, this may be simply because the profit potential of any increased borrowing has not yet been realized. So you have borrowed with a view of expanding your first half of the balance sheet so that it helps you in generating revenues. But then you find a situation where you've borrowed, yet your revenues are actually going down, your profit has gone down, and this net profit, which actually goes into your net equity, is very significant, or you're getting losses, which then it's actually taking your equity down. So the question is, what motivated you to borrow? What has actually caused these problems? It's just the macroeconomic fundamentals. They are not so intact. Therefore, they are actually affecting your business. Is it because you entirely depend on your inputs? You depend from foreign countries? So, and maybe your currency has depreciated against major convertibles, so it's becoming very difficult to generate meaningful profits. Maybe in the current scenario, you're generating losses, and it's actually now going to deaden your balance sheet or distorting your balance sheet. Are you now even having problems in servicing debt because your revenue productivity has actually reduced or been compromised? I know in these professional qualifications, you haven't started looking at most of these EBITDA of debt, but these are ratios that are very important that shows you in terms of your current EBITDA, if it continues in the next few years, how long would you take in paying in actually amortizing the debt? So you start looking at all these things. Then is it making sense?
A lot of it.
So here you have the interest cover. I know professional courses, you look at that, but in the corporate world, they would look at EBITDA over net debt. They would actually look at the debt service coverage ratio. They'll look at the CFEDs, which is the cash available for debt service, and come up with all these ratios. But here, obviously, interest cover, you're actually looking at from the operating profit, which is basically operating cash also. But obviously, we know that depreciation isn't there. How much is it? How many times is it able to cover your interest obligations? So this is why you come up with your interest cover. So it indicates the number of times profits exceed interest expense. This may indicate severe financial difficulties or that borrowings are too high for the company to support. If you find that your interest, for example, is higher than your profit before interest, then you know that you are actually going into bigger problems. You borrowed, but that borrowing did not actually support your asset base adequately so that the asset base can be able to generate meaningful revenues. Then it becomes a problem. So you're able to use this ratio to check whether you're actually in problems or not. So it is important to note that this is a ratio based on profitability, not cash flow, which would be a better indicator of company's ability to pay interest. But like I've said, in the industry where we are, there are quite a number of ratios around this particular topic that can be looked at. Like I've said, the debt service coverage ratio, your EBITDA debt, net debt, those are things that you can look at. But fortunately, they are not in your syllabus, so just ignore them.
Okay.
So on investor analysis, here now it's on your dividend cover. You find sometimes when you analyze companies where they've given dividends, yet they recorded a loss, meaning that they had to go into their reserves to actually give you dividends. Maybe it's by policy that they should be able to give dividends of this much. But maybe you might also find that in their reserves they do not have, they're going to borrow to give dividends. They just know that there's a problem. Because these dividends, they are actually meant for equity shareholders who should be in the best position. If the company is not doing fine, they should not actually be rewarded for these dividends. Above all, the shareholders are the ones that actually appoint the board of directors, who then now actually manage the affairs of the company. So they have the right at that point to dissolve the board and bring in men and women that they think would be able to maximize their shareholders' wealth. So here, basically, you're actually looking profit for the year divided by dividends to see whether the profit for the year is able to cover the dividends. Here now, it's basically on dividend yield. You're basically looking at your share price. Is your share price, is your dividends that you've gotten, is it really rhyming with the share price? Imagine why your share price goes down, yet you're getting higher dividends. Out there, the market, they believe that you as a company are useless, but then you're actually getting huge dividends. So this one shows the dividend yield from your share price. The PE ratio basically looks at the riskiness. Here is the price per share over earnings per share. So we expect that it should actually be, if it's lower than 1, then what it means that the market, yes, your earnings have gone up per share, but the market price is going down. Then it shows that the shareholders, they are so much in doubt with you as a company, because the price per share, which is the market price per share, is actually determined by the demand and supply. And what is the market perception over your company? If it's going up, then it means that there's a higher market, there's the perception that they believe that the company is doing fine, is better, and it's a good company to invest in. So if you find that it's lower than 1, then actually the company, it shows the risk levels of this particular company and the exposure. So I'll stop here. I know tomorrow we'll have to find time. I'll give you a call at what time I can bring in the other part on ratios, on how you can do your analysis in terms of ratios. I have a very good document that I'll show you. In the evenings, let's find time. We look at that report, Sidin, just so that I guide what we are supposed to do. I know we have had a long day. We started at 10:30, I think, financial modeling. Then we went into financial reporting, but then you can do your checkout.
Sure. No, thank you very much. I think the thing that carried my day was on the non-current assets for non-current assets versus non-current liabilities, and also the net asset turnover. These are the ratios that we normally ignore, yet they are very significant. And also the things to take away is the portable, because we are carrying assets which are not useful, they are not adding any value.
Yeah, it's dead weight, yeah.
It's an infraction, so it's important that these assets are weaned off so that you maintain an efficient.
I've lost you. I know you have network problem, but you have a network problem, but yeah, I think it's okay for now. So let's see. Obviously, I'll give you a call around maybe in the evening. We see what time we can just look at that report. We have had a long day today with me, so relax a bit. I'll definitely send the link to this video, and just subscribe on my YouTube account if you haven't yet, so that you're able to see it the moment it pops up. Sure. So thank you so much, Sidin, and have a lovely, lovely day. Thank you so much.
Thank you.
Bye-bye.
Thank you so much. Bye-bye.